Okay, folks, so GameStop had a peculiar and thought-provoking spike in the after hours on Friday, and there are major reasons to expect a pretty wild open come Tuesday. In fact, over in Germany, where markets were open today, well, GameStop had a very positive session, going up nearly 38%, which left the Germans saying, yeah, GameStop, nine stoppin'. So in today's video, I want to go through number one, why the spike in the after hours, number two, what just drastically changed on GameStop's balance sheet, and number three, why exactly the short squeeze setup has just become a lot more ripe. We'll be covering the next catalyst for GameStop coming on June 5th. And then at the end of the video, we'll break down our Lucy squeeze play, which went up some 373% briefing price to highs on Friday. We'll put all the timestamps down below, and before we get into it, make sure to do your own research on all ideas presented here on the channel. If you're the one taking the risk, you got to be the one doing the ultimate frisk. Also, happy Memorial Day. I want to take a moment to acknowledge and recognize and appreciate the many American troops who gave the ultimate sacrifice for this country. Absolute heroes, thank you very much. And we do have our Memorial 50 sale if you want to get 50% off either ZipU or Zip Options. We've had some pretty big winners in our options program as well as our ZipTrader U program as of the last couple of weeks, because this is a really hot market. So you might want to give it a look before the sale ends. Okay, let's get to work, and let's start with the context first. So GameStop starts seeing an increase in trading volume and activity somewhere around the 2nd of May. And then Sunday the 12th, Roaring Kitty tweets, and that starts open Monday the 13th off pretty damn hot. And then by open on the 14th, you've already hit a new high at $80. After that, the stock falls. GME sees huge dumping in the pre-market on the 15th. And then on Friday, the 17th, GME has a final fatal blow where they submit a filing registering the right to do an offering. This kills off a lot of the enthusiasm that Roaring Kitty had really catalyzed, and all of a sudden that upward sentiment volume no longer comes in. Then a week passes, and same thing. Not much luck at achieving a resurgence, but then Friday in the aftermarket, you get a noticeable pickup. Now, why would people start buying right before a 3-day weekend? Well, GameStop posted that they completed their offering. Quote, on May 24th, 2024, GameStop announced that it has completed its previously disclosed at-the-market equity offering, the ATM program. The company sold the 45 million shares of its common stock registered under the ATM program for aggregate gross proceeds before commissions and offering expenses of approximately $933.4 million. Now, if you go a little bit more into this press release, it says, quote, GameStop intends to use the net proceeds from the ATM program for general corporate purposes, which may include acquisitions and investments. Now, the thing that you need to keep in mind with GameStop is that it is not exactly a sinking ship. The idea that shorts try to paint on this stock is that it deserves to go to zero. Sure, this company has been flirting back and forth around the line of profitability, but no way is this anywhere near a sinking ship. GME put out a preliminary report 10 days ago and said that their net loss is expected to be in the range of $27 million to $37 million for the first quarter 2024. But compared to how much money this company has on its balance sheet, especially after this offering, well, this loss is really pennies. And there's a lot of reasons to believe that if you look at the full year for 2024, we're going to end up profitable anyways. And in fact, if you look at the last reporting from Q4, well, GameStop was profitable, and they swung profitable in fiscal 2023 after a net loss in 2022, even though in 2023's first quarter, they had a net loss. This first quarter's expected net loss is an improvement from the net loss in last year's first quarter of $50.5 million. And again, over the course of the full year last year, they still turned a profit. The truth is that Q1 has historically tended to be pretty weak for GameStop. If you go back to that last official report, the Q4 report, well, net income was posted at $63.1 million. They also already had a pretty decent chunk of cash equivalents, and marketable securities as well at about $1.199 billion. So when this company is going and raising $933.4 million more, it does indeed hurt the imminent squeeze thesis in the sense that there's around 15% more shares outstanding now, which makes the short's job easier to do in the shorter term. But at the same time, it actually helps the medium to long term squeeze thesis. How exactly, Charlie-Toe? Well, because it gives the squeeze thesis more time to play out. If shorts are betting that this company is going right towards zero, well, they need a bankruptcy to make that happen. GameStop is certainly seeing sales slag a little bit, but bankruptcy Hell not. A hedge fund manager just told QZ, and this quote was circulated everywhere, that, quote, most people think the company's going to go bankrupt. Now, if you never read a balance sheet, absolutely you're going to think GameStop's going to go bankrupt. But if you read their balance sheet, you would have to get your head examined if you think that GameStop's going to go bankrupt. The company was profitable last year. It may end up being profitable this year, and if not, even if it loses a couple $100 million, they've got tons of buffer zone. The whole short thesis is this company is going bankrupt, and that doesn't make any sense in any reasonable time horizon. Remember, in order to go bankrupt, you have to not be able to pay your bills. GameStop is not like a super exciting business model, but they're able to pay their bills, and even if they're losing a little bit of money on a quarter-by-quarter basis, it's still not nearly enough to go anywhere near bankruptcy risk. With this recent offering, they now have some $2 billion in cash equivalents, and marketable securities to work with, and the market cap of the company is only $5.82 billion. That means that over 30% of the market cap is in direct, near cash assets. This gives GameStop one major advantage that short sellers have continued to dismiss, and that is time, the big T word. The GameStop squeeze thesis is so strong because, quite frankly, GameStop doesn't need to thrive, they just need to survive and outlast the short sellers. And this money and the current fundamentals of the company support them surviving for quite a long time. But Charlie, wait, debt. GameStop has too much debt. GameStop must go down. That is what I read from the short sellers. And that is why I've decided to also short sell the stock, Charlie. People say that all the time. I read that in the comment sections, but again, I don't know exactly where this idea comes from, because if you look at the public disclosures that GME has to file legally, well, it says that long-term debt remains limited to a low-interest, unsecured term loan associated with the French government's response to COVID-19. But their latest filing shows that that debt is about $17.7 million in long-term debt, which again, they could easily pay with their some $2 billion in cash. But they don't, because presumably they like the low interest rate. And then you could say, but Charlie, what if they start losing hundreds of millions of dollars again? Well, okay, but again, they have $2 billion in cash, and if they wanted to, they could start cutting some of the unnecessary expenses like that. Downsizing would be very, very easy for GameStop to do, but they don't need to do it. And in fact, it doesn't even matter if they do, because at the end of the day, the game is not if GameStop is going to be a majorly profitable company, it's rather if GameStop can survive long enough to completely destroy the bankruptcy thesis. And the numbers, in my opinion, and if you look at the balance sheet, suggest that yes, they will survive long enough. So right now we're in a situation where short sellers are running the clock on their borrow fees, paying tons of money out the rear end to continue shorting the stock at the same time where GameStop's clock for survival is becoming more and more indefinite. Now, in many ways, this is the same story as 2021. Shorts betting against the company, while retail makes the short thesis less and less likely to pan out. And you could say, well, Charlie, you know what? I've heard all of these arguments for GME back then, but quite frankly, most retail that bought the stock and held all this time have been left holding the bag, and maybe at best, they're at break even. Why are you not talking about the opportunity cost with the GME play? Why are you not talking about all the better ways that you could have invested your money than this squeeze setup that literally was down for years? Well, certainly you're right to question that, and I would never say that there's one way to play GME. There's multiple different ways. That's why we alerted GME options before one of their biggest running days this year, and those calls went up approximately 279% alert price to highs. That's why we also alerted it in ZipTrader U for people that wanted to trade the stock and get in and get out. And those runs were just a few weeks ago. There were a lot of trading opportunities. But at the same time, for folks that did want to buy the dip low and then ride the momentum as the next wave of attention comes in, well, that was another very effective strategy, right? The people that bought and held at low prices, that was an effective strategy. So the point is, there's no doubt that there are different ways to play this stock. Now, I'm not going to tell you what you should do. You may think that GME should be avoided entirely. You may think it should be bought and held. You may think it should be traded. You may want to trade just options on it. Which strategy you choose is up to you. But all that I am saying here, and the main thing that I want to get across with this video, is that the thesis that this is going to zero is horribly, horribly incorrect. And in fact, the thesis that you get another round with a much, much bigger squeeze to the upside, in my view, is all but guaranteed. Whichever way you approach that information is up to you. But bigger picture, to answer the question, why did we get that after-hours spike on Friday, and why did we get that rally today in Deutschland's market? Well, the reason is because GameStop investors see GME as free and clear for the next round of momentum and the next round of efforts towards a squeeze. With dilution behind us, they see the setup as back on. That's my take. So the next part I want to discuss with you is the upcoming catalyst for the stock, which is earnings going out on June 5th. Now, here's the thing. If you study their last balance sheet, $921 million of their current assets are cash and cash equivalents. Presumably after the $933 million offering, you're looking at just under $1.9 billion in straight up cash. But what about this section here, marketable securities? What are marketable securities? Well, in their filing, it says these are largely short-term fixed income securities, probably T-bills, which means these probably went up marginally since the last report. So from a balance sheet perspective, you're going to see very, very healthy balance sheet. But what about from a revenue and or profit standpoint? Well, here's the thing. We already have that preliminary data, so markets are prepped for the bad, slightly bad news of a net loss in the range of 27 to 37 million and a net sales slump. But in my mind, look, you have this report coming out. Markets already prepared for that part of bad news, but they're also starting to look at that really, really good news, which is GME has a lot more time to squeeze. It wasn't anywhere near bankruptcy before, but now you have all this extra capital, which GME could use to ward off more short seller attempts at suppressing the price by investing in things that will produce more revenue generation and more profitability and more stability and a lot more time to completely destroy the short thesis. So in my mind, GME's earnings should be a net positive catalyst to look forward to. What do you think about GME? Let us know in the comment section down below. We love hearing from you. Do you think we're going to head for a new squeeze? Do you think this is going down? Do you think there's going to be another offering around the corner? You can let us know down below. Okay, moving on. Lucy, L-U-S-C-Y, Lucy McGoosey. So context, we briefed on the lovely Lucy at roughly 24 cents a share Friday morning, and it proceeded to run to $1.14 at highs towards close, around a 373% briefing price to highs run. What's the deal with the stock? Well, Lucy Goosey is Innovative Eyewear Inc., and it's a company that specializes in the development and sale of smart eyeglasses and sunglasses. And prior to Friday's trading, Lucy was trading at a steep discount from its real value. Thursday, they were trading at a market cap of $3.3 million. But if you look at their balance sheet, they had $2.648 million in straight up cash and $4.813 million in total assets. Liabilities at the same time were just $911,000. You subtract liabilities from the assets, and well, that means that you had about $2.9 million in net assets, and the market cap was only at $3.3 million. At the same time, this company is on the precipice of many different AI catalysts and had a huge history of spikeability. But that was only a foundation for what made this stock a good setup. It wasn't really the reason that we briefed on it. We would never have briefed on it if it didn't have some sort of catalyst to create an acknowledgement of that solid foundation of being undervalued. In fact, the main reason we briefed on the Lucy Goosey in the pre-market was because it had this unusual volume-driven price spike, and we know that Lucy has a long-term history of huge spikeability based around catalysts and volume price spikes, usually related to their AI exposure. If you remember last summer, we were covering this in depth with their ChatGPT partnership and all the spikeability that happened back then. So what exactly is the takeaway from this run? Well, the takeaway is that getting up every morning, doing your research in the pre-market, and finding real catalysts and real technical patterns and volume tracing, well, all of those things can go a long way in allowing you to trade and hopefully profit from some of the biggest catalyst runners in the market. And we do our best in ZipTrader Use morning briefings every single market open morning, as well as in ZipTrader options alerts to bring you the catalysts and ideas that we think are very, very likely to run. And cough, cough, coupon code Memorial50 will get you 50% off those membership fees. But the biggest takeaway is quite frankly that yes, the market is really, really hot right now. The meme trade is alive, and it is specifically focused. Retail is specifically focused on stocks that have been unjustifiably beat down, specifically, especially in the small cap market, and are ripe for a resurgence. This is a market where short sellers, especially those in the small cap market, have to watch their back, and where retail traders have to lick their lips because there's more and more opportunities every day. Anyways, have a great rest of your day. I hope you enjoyed your Memorial Day with your families, and I do want to give a final shout out to our troops. Thank you so much for your ultimate sacrifice, and we'll see you in the next video.